Let's get one thing straight. Conflict in the Middle East isn't just background noise. It can shake the stock market and your portfolio. The Middle East is the world's gas station. When there's trouble, everyone worries about oil supplies. That fear sends shockwaves from Tehran to Wall Street, hitting your investments before you've had your morning coffee. Investors hate surprises, and geopolitical flare-ups are the worst kind. Suddenly, it's not about company earnings. It's about whether oil keeps flowing. The Strait of Hormuz, a tiny waterway, is a choke point for 20% of the world's oil. If it closes, the global economy feels it instantly. Oil prices spike, and so does the cost of everything from gas to groceries. So pay attention. A drone strike thousands of miles away can impact your financial well-being. You don't need to be a foreign policy expert, but you do need to connect the dots. Ignoring these events is like driving with your eyes closed. Know the risks, don't let your portfolio be the casualty. Oil is the lifeblood of the global economy, and its price jumps at the first sign of conflict. When missiles fly, oil prices surge. Just like when the US struck Iranian facilities and Brent crude shot up 18%. Higher oil prices act like a tax on everyone. Companies pay more to ship goods and consumers pay more at the pump. Airlines, trucking, and delivery giants all feel the squeeze and profits drop. When people spend more on gas, they spend less elsewhere. Bad news for the whole economy. Investors fear not just oil spikes, but the economic slowdown that follows. But markets are forward-looking. If tensions cool and oil keeps flowing, prices can drop fast. Just like after Iran's limited response. The fear of disruption often outweighs the reality. Watch oil prices, they're Wall Street's anxiety meter. The market can swing wildly on headlines, but it's the fundamentals that matter in the end. Stay alert, but don't overreact. Oil moves markets, but panic moves them more. Keep your cool and watch the trends. When the US struck Iran, markets braced for chaos, stocks dipped, oil soared, and fear was everywhere. But as trading opened, the market rallied. Why? Wall Street bet Iran's response would be limited, not a full-blown war. The worst-case scenario didn't happen, so relief swept in and stocks bounced back. This is classic, sell the rumor, buy the news. Markets often price in fear before the event, then rebound if disaster is avoided. But don't get complacent. Geopolitical risks linger. Any new escalation, a ship seized, a surprise attack can send stocks tumbling again. The initial reaction is emotional, but long-term moves depend on real developments. Don't judge the market by one day's action. Stay vigilant, these risks don't disappear overnight. The market's mood can flip fast, so keep your eyes open. The Federal Reserve is the market's referee, and its decisions matter even more during a crisis. When oil prices spike, inflation rises. Normally, the Fed would raise rates to cool things off. But conflict also threatens economic growth, so raising rates could tip the economy into recession. It's a tough balancing act, fight inflation or support growth. Investors hang on every Fed statement for clues. Recently, hints that the Fed might cut rates, even as oil surged, calmed markets. The Fed's willingness to act as a safety net reassures investors. Watch both the headlines from the Middle East and the Fed's signals. The interplay between oil and interest rates drives the market's direction. Never underestimate the Fed's power, especially in uncertain times. So what's your move? First, don't panic. Emotional decisions lead to losses. Markets often recover quickly after geopolitical shocks, so selling in a panic usually locks in losses. Diversify your portfolio. If oil spikes, energy stocks may rise even as airlines fall. Focus on strong companies with solid balance sheets. They weather storms best. Use volatility to your advantage. If a great stock drops for reasons unrelated to its business, consider buying. Stay informed, but don't get lost in the noise. Watch oil prices, global headlines, and the Fed. But stick to your long-term plan. Keep contributing to your investments and trust in the market's resilience. Crises come and go, but discipline builds wealth. Stay focused, stay calm, and keep learning. That's how you navigate the storm.